On January 10, 2025, the People's Bank of China (PBOC) announced a suspension of its treasury bond purchases, citing a shortage of available bonds in the market. This decision ended a 5-month period of consistent buying and led to a temporary increase in bond yields. Analysts interpret this move as part of the PBOC's strategy to defend the yuan, which has been depreciating against the US dollar since the election of President Donald Trump. The suspension coincides with a global sell-off in bond markets, suggesting that the PBOC aims to align domestic yields with international trends or at least prevent them from declining further. Following the announcement, China's 10-year Treasury yield initially rose by 4 basis points but later settled slightly lower at 1.619%. The yuan experienced a modest appreciation, trading at 7.33 to 6 per US dollar, though it remains near a 16-month low. The PBOC's decision reflects a delicate balancing act, stimulating economic growth through accommodative monetary policy while preventing excessive declines in bond yields that could exacerbate yuan depreciation. The central bank has expressed concerns about potential asset bubbles as long-term yields reach record lows, even as it signals readiness for further policy easing. China's bond market has experienced a prolonged rally, intensifying over the past 2 years due to challenges in the property sector and a weak stock market, which have driven investors towards safer assets. This week, despite a global bond sell-off, Chinese bonds continued to attract demand, with investors anticipating further rate cuts in the world's second-largest economy. The yuan's depreciation, nearly 5% since September, is largely attributed to concerns over potential new trade tariffs under President Trump's administration, which could place additional pressure on China's economy. By halting bond purchases, the PBOC may be signaling to the market that it intends to prevent further declines in yields, thereby supporting the currency. Market analysts caution against excessive expectations of monetary policy easing. The PBOC's recent actions indicate a focus on maintaining financial stability and preventing rapid declines in bond yields, which could undermine the yuan and lead to capital outflows.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
The central bank has stated that it will resume bond purchases through open market operations at a proper time depending on supply and demand in the government bond market. This approach allows the PBOC to remain flexible in its policy implementation, responding to market conditions as necessary. The PBOC's suspension of treasury bond purchases highlights the complexities of China's current economic landscape. The central bank is striving to support economic growth while managing financial risks, stabilizing the yuan, and aligning domestic bond yields with global trends. This multifaceted strategy underscores the challenges faced by policymakers in navigating an uncertain economic environment. Impact on domestic markets. The halt in bond purchases by the People's Bank of China (PBOC) has caused ripples across domestic financial markets. Investors, accustomed to the PBOC's consistent involvement, are recalibrating expectations. Short-term volatility in bond yields and currency markets is expected as market participants assess the long-term implications of this policy shift. Currency stabilization strategy. A primary motivation for halting bond purchases appears to be stabilizing the yuan. With the currency nearing multi-year lows, any further decline could undermine investor confidence and lead to significant capital outflows. By curbing bond yields, the PBOC indirectly supports the yuan, signaling its commitment to maintaining currency stability. Global bond market dynamics. The suspension comes amid a broader global sell-off in bonds, driven by rising yields in advanced economies like the US and Europe. China's alignment with global trends may reflect a desire to maintain competitiveness in its bond market and prevent excessive arbitrage opportunities that could destabilize its financial system. Potential risks to economic growth. While the decision supports financial stability, it may create challenges for economic growth. Lower bond yields have traditionally supported borrowing and investment. A sudden shift away from this dynamic could dampen business confidence, particularly in sectors already under pressure, such as real estate and manufacturing. Signal to international investors. By halting bond purchases, the PBOC may be sending a signal to international investors that it remains committed to market-driven principles. This move could help attract foreign investment by showcasing a more stable and predictable monetary environment, even amid global uncertainties. Balancing inflation and deflation risks. China faces a unique challenge of balancing inflation in certain sectors with deflationary pressures in others. Halting bond purchases allows the central bank to control excess liquidity, reducing the risk of asset bubbles while ensuring that deflation does not take hold in the broader economy. Market speculation and future policy moves. The halt has sparked widespread speculation about the PBOC's next steps. Analysts are divided on whether this move is a prelude to broader monetary tightening or a temporary measure to stabilize market conditions. Future policy announcements will be closely monitored for clarity on the central bank's long-term strategy. Broader implications for global economies. China's decision has implications beyond its borders. As the world's second-largest economy, changes in its monetary policy can influence global capital flows. Investors in emerging markets and advanced economies alike will be watching how China navigates these challenges, particularly as global economic conditions remain uncertain. This comprehensive approach highlights the interconnected nature of China's domestic policies and their global ramifications. Effect on the property sector. The real estate market, already grappling with liquidity constraints, may face further challenges due to the suspension of bond purchases. Developers heavily reliant on low borrowing costs might encounter difficulties in refinancing debt, potentially exacerbating the ongoing property crisis. This could hinder the government's broader objective of stabilizing the sector. Potential for capital outflows. The PBOC's decision risks triggering capital outflows, as higher yields in other markets like the U.S. make Chinese bonds less attractive. This could put additional pressure on the yuan and complicate efforts to maintain a balance between domestic monetary policy and global investor sentiment. Impact on corporate bond markets. While the decision directly affects government bond yields, its ripple effects may extend to corporate bonds. Companies could face higher borrowing costs, making it more expensive to finance operations and expansions. Small and medium enterprises, which already face tighter credit conditions, are likely to be the most affected.
Long-term strategic implications. The move to halt bond purchases might reflect a broader strategic shift in the PBOC's approach to monetary policy. By allowing market forces to play a greater role, the central bank could be signaling a desire to reduce long-term reliance on interventionist policies. This transition, however, will require careful calibration to avoid destabilizing key sectors of the economy. This expanded analysis underscores the intricate interplay of domestic and international factors shaping China's economic decisions and their cascading effects across various sectors. Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.